We're half an hour away from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show and I'm Annabelle Droulers. Our top stories. Donald Trump announces more cabinet picks, including Fox News host and Army National Guard officer Pete Hegseth as Defense Secretary. Meanwhile, Elon Musk and Vivek Ramaswamy are tasked to head a new Department of Government Efficiency. Plus, President Xi Jinping urges all-out efforts to treat the injured and punish the driver in a car-ramming attack that killed 35 people in southern China. Asian stocks and treasuries falling while the dollar hits a two-year high ahead of key US inflation data that may dent confidence in Fed rate cuts.
And I'm Stephen Engel on the roof of the Royal Hong Kong Yacht Club, of course, here in Hong Kong, where we'll be covering the Asia-Pacific Investors Cooperation World Summit of pension funds, Social Security, and, of course, sovereign wealth funds. Our special guest hopefully will not be Tropical Storm Taraji, which is threatening in the background, but it will be the Financial Secretary, Paul Chan, to talk about his efforts to attract investment to this international financial hub.
A quick look at the market action, and undoubtedly what investors are going to be really passing over this morning are these new Trump picks to his administration and just some of the headlines coming out. We've got Pete Hegseth as the Secretary of Defense and also Elon Musk, Vivek Ramaswamy leading a new Department of Government Efficiency. So we'll dig into the details on that in just a moment. But in terms of the market action today, you do see the broader Asian benchmark under pressure, down 0.6%. And that's really the story of what was happening in the rates market overnight, plus the dollar. We saw Wall Street equities just pulling back or halting their advance, again, as investors really digested some Fed headlines coming through and this expectation. If you were thinking about 4 rate cuts for 2025 at the start of this week, you're now probably thinking about 2 instead, and it's that real question mark. Do we see that resurgence of inflation? US inflation data, CPI readings due out later today, so certainly something to track very closely. Let's switch it on. Take a look at what happened with Chinese equities as well. We saw that Golden Dragon Index slump overnight, down around 4.5%. Chinese futures today, again, looking weaker here. It's not just that story around the economy. And, of course, we've seen those economic figures disappointing. Stimulus that really hasn't met expectations either. And then as well, you add to it, again, this sort of hawkish on China stance that's definitely feeding through the Trump administration. Not only do we have Pete Hegseth as Secretary of Defense, there's been other key appointments in terms of that anti-China rhetoric that could really feed through. Taking a look as well at something that's really been moving in the last few minutes, and that's Dogecoin. We just had Trump saying that Elon Musk and Ramaswamy are going to be leading a new Department of Government Efficiency. Again, unclear as to how that could really work, but we do want to get into the details of that now and bring in our news desk editor, Jill Deeses, this morning. So, Jill, this is something that we sort of already knew. We'd heard Elon Musk talking about this and Donald Trump as well on the campaign trail. So it's not really so much of a surprise that he's been appointed, perhaps. But how exactly could this play out?
Yes, that's right, Belle. So ultimately, I mean, we had Elon Musk just at the Madison Square Garden rally that Trump had hosted a couple of weeks ago, where he had talked about what he saw as the need to cut a lot of inefficiencies from the government. That's kind of what this is all wrapped up in, it seems. I will say that, it's still incredibly unclear how exactly this department would look and what ultimate power Elon Musk would have in that kind of role. He said at that Madison Square Garden rally that he would want to cut upwards of $2 trillion worth of inefficiencies, as he saw it, from the government. Of course, that's more than Congress kind of budgeted for the entirety of the government in the previous year. So I mean, that kind of implies that there would be significant cuts, you would imagine, to services like social services, Medicare, that kind of thing. What that ultimately says about Elon Musk's power, though, and influence in this administration, I think it really kind of underlines how much power he's really developed and how much influence he has with Donald Trump over the course of this campaign. Obviously, I mean, he's donated, or at least has raised through the super PAC that he's had, tens of millions of dollars, over $100 million toward this campaign, and obviously Trump has chosen to reward him for that.
What about the conflict of interest? Because, and we've been discussing this as well, I mean, Elon Musk is someone who was CEO of 6 different organizations. If he does have this sort of key role in stripping out funding, it gives him direct line as well into the regulators that are looking after these companies, not just, of course, Tesla, but there's SpaceX, there's X as well, lots of different companies at play. How does that work?
Well, Belle, I covered Donald Trump in his first term, in the first administration. There's a lot of sort of hemming and hawing over what it would mean to address conflicts of interest just within Trump's businesses there. I think it was very clear by the end of that administration that Trump didn't really care, and he didn't really do a whole lot to, sort of siphon off and cordon off different segments of his own business from what he was doing with the government. I'd have to imagine that that philosophy might be something that carries out through the rest of his administration, including potentially to Elon Musk. I mean, how much that actually weighs on, what other institutions are in place to kind of, prevent or try to encourage administration officials from preventing conflict of interest, we'll have to see. But really, I mean, I think, the leadership kind of comes from the top, and this is not something that Trump has really concerned himself with in the past.
Another appointment that's just come through, or nomination, is Pete Hegseth for Secretary of Defense. So this is someone who would already be known to several people, not least because of his role as a Fox News host for several years.
Yeah, I mean, look, again, you look back toward the first Trump administration, which, had some more traditional establishment candidates in Trump's cabinet, but he also had, a couple of people. Larry Kudlow, CNBC anchor, ended up being, his economic advisor at that time. So not entirely surprised that, Trump has kind of picked from the world of TV, which he, of course, embraces and loves, to fill out his cabinet. Now, what that ultimately means in a pick like Pete Hegseth, I mean, this guy is, he's a hardliner. He's certainly said some fairly hardline comments on Iran, for one thing. And I think when you look at the totality of what Trump's cabinet seems to be shaping up with so far, I mean, some pretty strong choices on foreign policy. We've talked a bit about, the potential for Marco Rubio to become Secretary of State, a big China hawk, big, hawk on the Middle East. I mean, this seems to be kind of reinforcing some of those picks there.
Yeah, big question, because he is someone who's been quite hawkish on China as well, it seems, not least Iran as well. But that was our Bloomberg News Desk editor, Jill Deesis, there. And later we're actually going to be hearing from Arnold and Porter for their assessment on Trump's latest cabinet picks and what it could mean for US trade strategy as well. Let's get more on this now. Bring in Monica Hsiao. She's founder and CIO of Triada Capital. And Monica, I guess that's really one of the key questions here around the Trump administration. It seems very much focused on deregulation, pro-business, pick-up in things like M&A. There's also that big question, though, do we see that resurgence of inflation, and what's really going to win out the battle there?
Right. I mean, this is what we're seeing now, from overnight markets, is that sort of Trump trade on rates has come back. We had a huge buildup of that trade in rates where you saw the steepening and also 10-year going above 4.4% leading up to the elections. And that is on the fear of inflation. The inflation is not only that potentially through tariffs, but also, we really don't know how much the deficit can go as well. And so that all depends on the budget. But that being said, I want to be a little contrarian today, given, where the rates have already moved. And I would say that the probability of a December cut, I think, is a bit overdone in terms of being only like a 0.58 or 0.6% probability now for a December cut. I actually think December cut is still very much on the table. If you look at what Powell had said, of course, we do still have more data coming, CPI tonight and then PPI. But I think that the Fed is still leaning towards a more dovish stance until they see what we get on tariffs.
So do you think, though, that Jay Powell does need to sound a little bit more hawkish?
I think that he's doing what is appropriate, in my opinion, right now, because he just doesn't know. And I think that this is going to be the theme for us in Trump 2.0, is really that we just don't know. And I think this is including the fact that we can't really tell whether Trump is really going to be escalating to de-escalate. So a lot of things that he says, it may be rhetoric and posturing. I think if you look at what Scott Bessent, who's, basically the front runner for Treasury Secretary, what he's saying. I think he's telling us over and over again that Trump is actually a free trade thinker. So we have to take that into account. And I think on the inflation front, we have to remember that Trump did run on a platform to beat inflation. And so as far as the deficit is concerned and the budget, I do think the Republicans are going to try to take sort of a more balanced stance and probably be less profligate than the market thinks.
Where does that leave you then for your expectations around easing for next year?
Yeah, I think this is the, billion-dollar question is really about next year. And at the moment, I feel like we have to be in a wait and see. I think that believing there could only be 2 cuts next year might be, again, overdone. It's a market reaction right now. I think somewhere in the region of 3 to 4 cuts probably still makes sense, but we do really have to see, there's so much to come that we on the trading side have to be constantly adjusting right now, including, the shape of the curve, how steep does it go and so forth. And, this also leads into, everything that we're asking here about next year and the rate cuts, so forth. That leads into how strong the dollar will remain as well.
Exactly, yeah. And that's what I was going to ask, because it does seem like the stage is sort of set for dollar dominance to extend further. What does that mean for the carry trade?
Well, so I think as far as the dollar dominance, I think that will be the case still through next year, because regardless of the number of cuts, which is obviously one factor feeding in, the other thing is this is really just all about differentials between policy rates across countries. And you could see that in other countries right now, they're really all poised to be cutting more, particularly ECB. So I do expect the dollar strength to continue, and especially in light of this administration, which puts America's exceptionalism back into the spotlight firmly. So not only on a relative performance of the U.S. on growth, but also just in terms of the relative weakness of the other countries, potentially, depending on how the tariffs escalate.
And of course, no country is more at risk of those tariffs than China.
Yes. Yes.
So then it's sort of the question is, how does China sort of prepare for this? I mean, we've already been hearing from officials that are saying perhaps they've got more cards up their sleeve to try and tackle those tariffs, but one of those could be the yuan. And we've seen the PBOC not really pushing back too much on that weakening trend. How far do they let it go, do you think?
So, the CNH being around 7.3 area, I think it could weaken more, definitely in the short term before. I don't think that they necessarily want to see the yuan go crazy in depreciation before the tariffs are actually, announced. They do want to save some room for the negotiation on that. But I think going to 7.6 is quite possible. Yeah, quite within reach. So being short CNH right now makes sense. Yes, they do have more powder for fiscal expansion, and they just still haven't chosen to announce anything very substantive. As you know, we were, the market was quite disappointed with what came out on Friday, which wasn't that much incremental credit expansion, which is really what you need to have that fiscal expansion. We're still waiting to see the December Politburo guidance for next year's budget. So, I think that the Chinese government likely is saving the powder right now, wanting to kind of take a cautious stance a little bit to see what Trump does. I think the whole world is in that stance of sort of waiting with bated breath and then, thinking about all the policy tools that they can pull levers on.
What are the ones that they do mostly likely pull on? Because I think we've already seen easing this year. We've seen some fiscal stimulus, and it hasn't really worked, not only in terms of the market reaction. We haven't seen a sustained recovery in equities, but at the same time, we've seen, for instance, the credit data that also told us that households and corporates, rather, just aren't interested in borrowing either. What would actually move the needle, do you think?
I think the focus always still comes back to the property sector. And right now, we're in a trend where on a 12-month rolling basis, there's a decrease of $1.3 trillion yuan, in revenue on a rolling 12-month basis right now that are, from the lack of land sales. So this is something that I think the government ultimately needs to address first. The buying back of idle land, which we expect, but and hope for something substantive on that. I think that you do need to clear up the inventory. I mean, it's reported in some papers that up to 90 million empty sort of apartments from developer side are still in the inventory. This is not including a secondary market that you may have some open homes for sale as well. So I think that you actually need to address the property sector first. So I think it's up to the government at this point, besides clearing up some of the accounts payables in the property sector, which is what they're trying to address with trying to clean up the LGFVs side, the local government's balance sheets. So they still have several steps to go. I would say that right now the goal is to just destock and stabilize the current market. We're, I think, several years away from really pushing up the property market.
Yeah, certainly a multi-year problem. That's what we keep hearing. That's Monica Hsiao there, founder and CIO of Triada Capital. And just as we were discussing there, the yuan fix has come through, reference rate at 7.1991 per US dollar. The estimate had been for 7.2436. We are just, of course, continuing to track the offshore yuan there, trading around a 3-month low against the greenback. And we're counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. Plenty more ahead. This is The China Show. All right, taking a look at Dogecoin this morning. We've seen it really ripping high here today. It has been one of the standout altcoins in the space, especially given its connections, of course, to Elon Musk. And just in the last hour or so, we've had Donald Trump coming out saying that Musk and Vivek Ramaswamy are going to be leading a new Department of Government Efficiency. We saw across the campaign trail these promises to really cut back on government spending and cut the waste, essentially, that Donald Trump sees in Washington. But let's get more with our news editor, John Harney, joining us from Washington. John, what's your initial take on this? Of course, as I said, we had it being discussed across the campaign trail. Now it seems like it could actually be coming to fruition.
Yeah, so it's a little bit unclear as yet how this would work out. Musk, who of course is the world's wealthiest man and has many government contracts, might come into the administration as sort of a employee of somebody who was in there temporarily, sort of almost like an informal designation. But much has to be worked out, and but it's still a remarkable announcement.
How exactly would it work with the two of them heading it up? Do we kind of get any details around the structure of it as well?
So far, no. I mean, President-elect Trump in this announcement was praised both of them for their ideas. Of course, as I think you pointed out, Musk famously said during that Madison Square Garden rally toward the end of the campaign that he could cut $2 trillion from the federal budget. I mean, that would involve an enormous reduction in federal spending that would touch just about everything, including defense. So again, it's all it's all very new, and yet Trump has again, President-elect Trump has again displayed his flair for the dramatic. and this is certain to be the talk of Washington tomorrow and for many days to come, until up until probably the inauguration.
John, I'm sure you're in touch with many different government employees. If you're sitting in one of those positions, you might be a little bit nervous about it. How is this likely to be received, and can we expect any sort of pushback?
Well, certainly. I mean, there will be objections and criticism. But Washington is understandably nervous, as they are. There's a certain amount of anticipation or anxiety when any new administration comes in. But this is different in that Trump and his allies have said they will restructure, reform, reinvent the government. So Washington is, in some respects, although it has other industries and colleges and universities and that sort of thing, is very much a company town, and the company is the government, both in the district itself and in the Maryland and Virginia suburbs. So there's certainly some trepidation about all this.
All right, thanks so much for joining us. And John, really look forward to getting more context on those conversations you have tomorrow as well. But that was Bloomberg's John Harney there in Washington for us. And Donald Trump and Elon Musk are also the topic of today's Big Take. It's a really great title on this article. Elon Musk has a new project to run, and that's Donald Trump's government, really just underscoring this key role that he seems to be playing so far in the new administration. But subscribers can read our in-depth look at Musk's influence in the White House. You can get that on the terminal or at Bloomberg.com. And also, quick check on futures. Of course, we're just under 10 minutes away from the open now in Hong Kong, mainland China, and we are seeing that weakness here really corresponding to that drop in the Golden Dragon Index of 4.5% overnight. Geopolitical fears, of course, fanning this, but you've also got that economic data that continues to disappoint. More ahead. This is Bloomberg. Just some breaking news crossing the terminal this morning in the last couple of minutes. China is going to be marketing its first dollar bond since 2021. Really interesting story around where they're planning to do that, because they're actually going to Saudi Arabia for this issuance. $2 billion of notes, that's going to be sold up to that level in the week commencing November 11. So that's this week, the statement coming through on Tuesday. Plans to sell dollar debt in Saudi Arabia could really be about those efforts to try and boost that economic and financial market link that we're seeing between China and also the Middle East, and Saudi Arabia in particular. Hong Kong, of course, one of the key conduits between the two places. But what to watch as well in Greater China today, Hang Seng sell-off, very much a watch here, given we dropped below that 20,000 level. Key resistance also in focus. Showing you some live picks here. Really, I guess you could say he's the man of 2024 at least, and probably into 2025. Jensen Huang, of course, NVIDIA CEO. He's actually in Tokyo for NVIDIA's AI Summit, Japan, hearing more about NVIDIA's work with the Japanese AI ecosystem, exploring what's possible around AI, accelerated computing as well. So he's taking to the stage here. We are, of course, awaiting for a fireside chat, possibly between Huang and also the SoftBank founder and CEO Masayoshi Son. That's coming up later today. But that's Jensen Huang there. We'll leave that and head to what we're seeing, of course, for mainland equities. And certainly these are less in favour than anything linked to AI, because we have continued to see that drop across the board here. Golden Dragon Index, for instance, down 4.5% overnight. But really, China is facing a few different factors here. Firstly, you've got this economic weakness, and we haven't really seen that stimulus feeding through. Stimulus itself has underwhelmed. And, of course, you continue to face these hawkish incoming Trump administration. We just had the defense secretary, for instance, being appointed, but we've had other key positions as well being announced that tell us that really the rhetoric and that trade war could only perhaps heat up from here between Beijing and Washington. So the CSI 300 down 0.4%. And as well, if you switch on, take a look at what's happening in Hong Kong. Earnings themselves, we haven't had too many filterings through so far, but broadly what has come through has been perhaps a bit of a disappointment. Some of the key ones to watch this week, there's Meituan. We're also watching out for Tencent, Alibaba as well, but you do see the Hang Seng Tech Gauge down 1% so far. Movers to note, as I said, we've got Tencent, but Tencent Music reported overnight, Alibaba and JD.com, of course, also on the docket. Again, Tencent Music, you are seeing that slump here of nearly 9%. It tracks what we saw in the ADRs. Baidu and Geely are keeping a track on some of these EVs as well, these EV names. We are just seeing those a little bit weaker so far, but the story around Baidu is that they've applied to launch an autonomous vehicle trial in Hong Kong. That's according to a report. It could be taking place at the airport. So something that's exciting, at least for Hong Kong in this shift to autonomous driving. We've seen Baidu, of course, rolling out trials, most notably in Wuhan. But Chinese equity valuations, they're actually still below the average during the first Trump administration. That could imply some upside for stocks, even as the president-elect, as we were saying, threatens higher tariffs on Chinese goods across the board. Let's bring in our senior equities reporter, Abhishek Vishnoi. And Abhishek, why won't China derate meaningfully with Trump, given he's adding so many China hawks to his team?
Yeah, the setup is that of trade war, China hawkishness, and U.S. exceptionalism. But let's not forget the valuations, which are at about 10x for MSCI China, very, almost at the lowest that they had hit during Trump's first term as the U.S. president. During that term, the valuations averaged at about 12.3 times out of something, and right now we're trading at 10. So it's a material discount. And look, Trump, trade war, these are not novelties. We've been there, we've done that. So China is less reliant on the US, more experienced now. That's the setup for valuations. On earnings growth side, while, onshore earnings are, not that great as per results season, if you look at the 12-month earnings outlook, things are improving, especially because of tech. It's come to a point where MSCI China is now offering India-like earnings growth over the next 12 months. So that's the earnings growth part of it. Other than that, if you look, there is less reliance, and China has enjoyed historically a role of diversifier. Like, that diminishes a bit because of yuan depreciation. But, given stimulus, is coming in, dripping in constantly, and there is more promise of more fiscal efforts being carried out in the upcoming meetings and possibly NPC meeting in March, the setup looks pretty great, where China can tackle, and not meaningfully derate, even if Trump sort of drums up his playbook. One more thing to remember is that there is no discounting of any sort of bargains or deals that Xi Jinping and Donald Trump can carry out. And that has been the playbook in the first trade war. Year one, you may see a lot of rhetoric against China. Year two, some kind of deal, some kind of pause in the tensions, and then China and even names like Mexico rallies on. So that's why overall the setup looks like a setup where China won't derate meaningfully.
Yeah, to your point, I think economically what the US wants out of this, it's going to be hard for Beijing to meaningfully or credibly deliver on. So how do you see China trading then against that backdrop of tariffs or that hawkish rhetoric, and as well that continued economic weakness?
Yeah, so I was talking to some investors, and this is how they've divided how the trade is going to be. Of course, on one side you have trade war, the other side you have China stimulus, right? And there are green shoots emerging, both, if you look at the PMI readings, if you look at MSCI China earnings, they may be led by tech, but then they're flowing at the top level as well. So, year one, this is a box trading where China, trades in a range, a sort of a narrow range, a bit higher daily volatility. And year two, there is some discounting of some kind of pause in US-China tensions, some deals happening, and then we'll see, the emergence of a great bargain where people start discounting, that China would also can do well like the first term. So year two would be something of a rally for China. Year three, year four is when the focus would once again come back to long-term earnings growth. But this remains a setup for U.S. exceptionalism. So there would be a lot of allocation that would be from global portfolios that will remain in U.S. or go back to the U.S. And China, like any other EM, would suffer a bit. But people are looking for diversification ideas when yields are so high. And China has commanded that kind of role in the past. So if they can manage some kind of deal, after Trump comes in power, then, the setup looks pretty nice for year two. A lot more gains for China.
All right, that was Bloomberg senior equities reporter Abhishek Vishnu in Singapore there, and it does really seem like there's a lot of different hypotheticals and ifs in the equation so far. But let's get more on that now. Bring in James Wang. He's head of China strategy at UBS Investment Bank Research. And what do you think about what Abhishek was just saying there in terms of do any sort of opportunities start to appear, and is there any sort of room for cooperation or collaboration at all?
Yeah, so thanks, Annabelle. So from our perspective, I'd say a Trump victory is negative for Chinese equities. But the thing to highlight is that for listed companies, actually the US revenue is a very small proportion. We're talking about 3% of total revenue. So the biggest driver is really the domestic economy, and to what extent the domestic policy offset the tariff impact. But that said, Trump does bring added uncertainty to the market. So we think the earnings impact from tariff is maybe 3 to 5%. And then added uncertainty adds another maybe 5% derating to the market. So we're talking about maybe 10 to 15% downside from the Trump victory alone. But what extent the domestic policy offset, we have to see.
Domestic policy, I mean, it's not just, of course, that question around the trade tariffs between the US, rather, and China. I mean, protectionism is rising across the board here.
Yeah, so we have seen, for example, tariffs being implemented by the EU on Chinese car makers. And I'd say that's, again, definitely it's a negative for Chinese equities. But again, I think there's a confidence factor that's impacting Chinese equities and Chinese entrepreneurs. We've seen, actually, if we look at the revenue for listed companies, actually very, very weak. We're talking about 0 to negative 1% revenue growth. So to the extent the domestic economy stabilizes, that is a bigger driver for the Chinese equity. And we can see that coming through in the next couple of quarters because in the first half, fiscal spending is very weak. But we've seen acceleration in fiscal spending with the local government debt swap. So revenue growth should start to accelerate. And also, to what Abhishek is talking about, fourth quarter last year was actually a very low base in terms of earnings, and we start to cycle low earnings base going forward. So earnings growth should also accelerate, and that also bodes well for Chinese equities.
Is that sort of the key areas that you're looking at then? Because we're coming into the earnings season. We've had a couple so far, but it's been, I guess, a little bit disappointing.
Correct.
Yeah. Which other metrics are you looking at in particular?
So earnings were down, actually were up 1%, but revenue was down 2% in the third quarter. So it's not the greatest picture, but we have seen some green shoots in the sense that we haven't seen the internet companies report so far, but we still expect more margin improvement from these companies. And the other thing is CapEx was actually down. So CapEx was down 6% in the third quarter, 4% in the first half. So what that tells me is that everyone's talking about all these excess capacity that we see in China. The industry is actually organically solving itself. So the CapEx reductions, where are they coming from? Industrials, renewable, exactly where all these excess capacity is. So we do expect the margin or the excess capacity profile to start to improve going forward.
So if you're thinking about putting together a portfolio focused on China, how do you want to play it then? Yeah,
so I do think export-oriented sectors, they are still at risk. If I look at what's being priced in, how they're trading, they actually haven't come down nearly as much as I would expect with the potential looming tariffs. So we would advise investors to stay away from the export-oriented sectors, particularly machinery. We do have some defensive portfolio, defensiveness in our portfolios and things like major banks, where we still expect interest rates in China to continue to fall. So the banks should provide a bit of a hedge against that front. And the other things in terms of attack were still very much like the internet names in China, where competition is relatively benign. They're doing tons of buyback. If we look at the top listed internet companies, we're talking about 3% annualized buyback. And then consumers, the other attack options. So domestically focused sectors is where we'll be focusing on. So things like restaurants, even Macau gaming is some of the areas that we think are interesting.
Even though the consumer in China is looking pretty weak still.
Correct. Well, one thing is, if you look at the consumer names, they're actually taking a lot of cost out of their business. So if you look at the third quarter earnings, consumer sectors were up something like 20%, revenue growth 1%. So they're doing tons of cost cutting. And to the extent that the domestic demand starts to be boosted because of policy support, I think there is upside, even from the revenue perspective. And on top of it, you got the cost outs. So to me, that's the biggest opportunity.
The opportunity that you see in internet, so you said there's not that much competition. I feel like if I was the head of a company, of an internet company, I might say otherwise. In China, it seems very tough, the competition between some of them. But there has been also that focus on cost-cutting, streamlining.
Correct.
Do you start to see that coming through now?
Yeah, I mean, if you look at Tencent, we're talking about profit. They haven't reported yet, but if you look at the first half, gross profit up 50%, right? And so you can see that's where the cost-cutting is coming from. And I also think you're not really seeing a lot of new entrants into the internet space. Yes, there is seemingly a lot of discounting that's going on, but part of it is because some of the consumer companies, they've actually ratcheted up their supply during 2021 when conditions were very good. So a lot of the discounting was actually done by merchants. Albeit the e-commerce guys, yes, that's where most of the competition is. But other than that, competition is relatively more benign compared to what we've seen in the past.
All right, James, thanks very much for your time this morning. That was James Wang there, Head of China Strategy at UBS Investment Bank Research. Chinese markets about 15 minutes or just under into trade this morning, and we are seeing them, pretty much the downside here. We've got the Hang Seng off more than 1%, Hang Seng Tech 1.5% in the red as we wait, of course, a big week for China tech earnings. Tencent, Alibaba, Meituan, just some of the names that are going to be reporting. More ahead, this is Bloomberg. Chinese President Xi Jinping has ordered local authorities to ensure safety and social stability after 35 people were killed and 43 injured when a man drove a car into pedestrians in the southern city of Zhuhai. For more, let's bring in our China correspondent, Min Lo. And Min, this is really a very rare event to happen in China, this sort of mass attack and violence. But just tell us exactly what happened on Monday night.
Yeah, it's a very horrifying incident because I just looked at some of the social media footage that was circulating. They've already been taken down, but there was this footage of just bodies strewn on the ground. The 62-year-old man was in a small Jeep and he rammed into these pedestrians, really people who were exercising in a sports center, running around the tracks. He drove in and rammed these pedestrians, killing 35 people. The official reason here is that he just divorced and he was upset with his property division. But when he was apprehended by police, he was wielding a knife, so he basically harmed himself. He's in a coma right now, so not available for questioning. Investigations are still ongoing. But of course, there has been this outpouring of support, condolences from people lighting candles, offering their flowers at the site of the attack. And on social media as well. Extremely, extremely sad incident.
It is, as I said, quite rare as well. I mean, China is a place that can justifiably point to a very sound safety record.
Yeah, I mean, it's really impossible to get any firearms in China, so it's very rare to have these large-scale attacks. And oftentimes the more common form of attacks is in the form of knife attacks or vehicle rammings that has taken place before as well. In September, there was a Shandong school bus that rammed into a group of parents and students, killing about 11 people. The last time we saw something close to this scale was back in 2014 in Kunming, when a man with a knife was just went on a rampage through the train station, killing 29 people. But yes, I think what is noteworthy is that this took place in Zhuhai, which is already under heightened security because of this very high-profile military air show that was taking place about 40 kilometers from the site of the incident. And also, as President Xi is poised to leave the country to attend the APEC and G20 summit in Brazil and in Peru as well. And of course, President Xi has responded very swiftly, calling on local officials to really make sure that disputes are settled quickly so that these things don't happen again, and to ensure social stability and to protect people's livelihoods.
Right, well, we'll certainly be watching for any more details on that, but it does seem at least a lot of them have been removed from official channels, at least for now as well. That was our Bloomberg China correspondent Min Min Lo there, and we'll have more ahead. This is Bloomberg. Hayman Capital CIO Kyle Bass is hailing Donald Trump's expected appointment of officials with strong anti-China views. He told us that Marco Rubio, who could be named Secretary of State, and Mike Waltz as National Security Advisor, both understand what he calls the China threat.
You know, when you describe everyone as a China hawk, I would just call them China realists. I mean, Xi Jinping has been telling you what he's going to do since 2017 in every public speech, every public appearance he's made, and truthfully, every meeting he's had with U.S. officials. So when we start realizing that China is not our friend, and if you read the Director of National Intelligence's annual threat assessment report to Congress, in no uncertain words do we say China is the largest threat to U.S. national security. So I think it's important to note that our leadership has done a poor job in explaining to the American public what kind of threat China actually presents. Now, I've worked closely with Marco Rubio and his staff over the years, and several of the other people that are being nominated here, and these people understand the enormity of the threat that China poses to the Western world and to the security of the United States. So again, whether you call them hawkish or realists, what we're doing here is we need to stop affording China these battlefield asymmetries that we're giving them, and you know, we can go one by one the asymmetries we've advanced. But Rubio is a very, very strong pick for Secretary of State. You know, he will bring with him the gravitas, and I think the Democrats are really worried about Trump's stance on ending the Ukrainian war in one day by ceding advances to Putin. And if you know Rubio, I don't think that's going to happen. So I think we've got to be realizing that all of the bad guys are all together in fighting against the West, and putting Rubio in place, putting in Treasury Secretary. You guys started talking about the markets. Like, the markets are factoring in Treasury Secretary Scott Bessent becoming
Kyle,
the next Secretary.
let me follow up on that point. We're talking about the markets. What does this mean, these kinds of picks mean for Chinese assets? And how would you personally, your firm, express it beyond the Hong Kong dollar short that I believe you had last year?
Right. We have no other positions on other than that position. We've carried that position since 2017, just to be clear. You know, if you invested in China 16 years ago in their largest equity index, the Shenzhen Shanghai 300, their GDP went up 505% in the last 16 years, and you've lost a third of your money being invested in their markets. Just imagine losing a third of your money in a nation that's grown its GDP 500%. When the U.S. has grown our GDP about 75%, and you're up 400% in your S&P 500 investments. Investing in China is a fool's errand. It is, no one has ever made money in the long term investing in communism, and no one ever will.
That was Hayman Capital CIO Kyle Bass speaking with our colleague Scarlett Fu there. And here are some of the stories we're tracking this morning as well. AstraZeneca's CEO Pascal Soriot says several healthcare companies are affected by compliance issues in China, including alleged illegal breaches tied to data privacy. A handful of current and former Astra executives are under investigation for illegal importation of cancer drugs, but Astra says the company remains committed to the country. Citigroup CEO Jane Fraser says it's game on for M&A in the US. Speaking with Bloomberg, she says clients that were waiting on the sidelines to do deals are now ramping up plans following Donald Trump's election win.
I think there's a lot of pent-up demand, but at the same time, I see particularly in the States, which is the majority of the M&A activity at the moment, and is likely to be that way, it is game on. The clients are on the front foot in the States.
Checking on other markets and some of the names we're watching this morning, travel stocks not really responding that well to this. Good news for people that are working in mainland China this morning, because China's actually added 2 public holidays from 2025, and it's all about this effort to try and boost consumption, promote the development of the service industry, improve productivity. Of course, people talk a lot about the 4-day work week, maybe not a reality yet in China, but at least you're getting 2 more public holidays starting next year. They're also looking to increase railway and civil aviation capacity. So that's those stocks there. You are just seeing pretty much downside pressure coming through. But let's take a look at what's happening across broader benchmarks this morning. And you are seeing that weakness, particularly expressed in Hong Kong so far, below the 20,000 threshold. And we're looking at losses of nearly 5% across the course of this week. Hang Seng Tech as well, as we await some very key earnings coming through. Continuing to track what's happening in the offshore yuan. We did see the dollar gauge extending for a 4th session overnight. We have the offshore yuan sitting around a 3-month low against the greenback. And a weather alert as well for people watching in Hong Kong this morning. A strong wind signal of 3 is going to be issued at 2:40 p.m. this afternoon. So we're hoping that, of course, Stephen Engel is saying safe and dry for us, because he's got a big interview coming up. Paul Chan, Hong Kong's finance secretary, joining us in about 15 minutes from now. Lots to discuss, not least the continuing cooperation between the Middle East and China. Welcome back to the China Show. Well, we're half an hour into the trading session so far for mainland and Hong Kong equities, and the Hang Seng really bearing the brunt of the losses once again. We're down around 1%. Hang Seng Tech leading the drop here, and some of the big losses or laggards. Meituan, for instance, contributing the most. It's down around 2%, but you've also got Geely as well, down 5.3%. So big losses coming through as we await some very key earnings this week. Actually taking a look at them, for instance, China Education, for instance, they've lowered their guidance. We had Tencent Music. If you take a look at how that's faring so far in the session, a big drop tracking what we had in ADRs overnight on Wall Street. Let's take a look at some of those movers, and as well, Zylab posting losses. Tencent, one of the key names we're going to be tracking throughout the session today, given we are awaiting those earnings. We have seen that big effort on cost cutting coming through, and also streamlining of businesses, plus a gaming renaissance across China. Is that something that helps with its bottom line? Broadly in the session, Asia ex-China, taking a look at how that's faring so far, and it has been a real story of weakness. We saw, for instance, high yields overnight, a firmer dollar. These are twin headwinds for Asian equities, and we saw the broader gauge down 0.8% so far. The Nikkei, Kospi, both of those tracking more than 1% to the downside as we continue to see yields yesterday around a 12% basis point jump for the 10-year. Today, fairly steady so far. But let's bring in Bloomberg MLife strategist Mary Nicola in Singapore for us. And Mary, I want to start off as well with what's perhaps maybe not dominating markets so much, but certainly dominating the news cycle this morning, and that's these appointments that Trump has made to his administration. A couple of them really stand out to us. Of course, there's Vivek Ramaswamy and Elon Musk to this new cost-cutting enterprise. But as well, we've had the defense secretary, who is someone very hawkish on China, Pete Hegseth. Others in the administration, it seems, also going to be hawkish on China. How much does this also ratchet up the tensions and add to the headwinds that are facing Chinese equities and the yuan in particular?
I think during the campaign trail, Trump made it very, very clear that the focus was going to be on China and in a more hawkish way. So a lot of what he said on the campaign trail is being fulfilled. And that's, of course, causing concerns within the market that the tensions between the U.S. and China could only escalate from here. So, of course, we'll see pressure on the CNY. We'll see pressure on the equity markets, not only over the next few weeks, but even into the next year as the Trump administration and the new Trump administration unfolds. So I think the headwinds for the CNY still is likely to continue with this clear overhang that we're going to have on tariffs and on escalating tensions between the two countries.
What about the other appointments? As I mentioned, there's Elon Musk and Vivek Ramaswamy to this cost-cutting new government appointment. But then there's also sort of that broader focus, and we've seen traders already reacting to this, the deregulation that could also be set to come in with Donald Trump back in the White House. Does that sort of have more of a bearing on the market direction, also corporate tax cuts, versus this expectation that we could see inflation heating up again off the back?
I mean, one of the major optimism that we've seen off of the Trump win has been the fact that deregulation is likely to come through, and obviously that's going to only help business sentiment, business investment as well. But the other key drawback for markets, especially for the bond markets, is that if we do have this trifecta where the Republicans are in control of both the legislative and the executive branches, it means that we are likely to get more fiscal spending. That's going to keep the pressure on bonds, and that's going to keep investors quite worried. So at the end of the day, the budget deficit doesn't matter until it does. And now it's starting to become more of a concern and more pressure on bond markets as a result, because it can come to the point where it could be a little bit too much to contain. Now, take, for example, this focus on government efficiency. While that's all well and done, it really matters of what is going to be the byproduct of it. Do we, and especially with tax cuts likely to come in tandem. So there's still a lot of uncertainty surrounding how the deficit picture unfolds and whether that really comes to fruition to help the bond markets or actually hurt them even more.
Yeah, it certainly presents a real quandary to Fed officials, and we've been hearing from a number of them post that Fed decision last week. Thomas Barkin, for instance, the Richmond Fed president, spoke about the outlook and how they're really preparing themselves for it. Take a listen.
You got a strong but choosier consumer, coupled with a more productive and a better valued workforce. And that's landed the economy in a good place, as I said. The Fed's in good position to respond appropriately, regardless of how the economy evolves.
What is going to be the response function, though, of the Fed? Because if you came into this week, you were maybe thinking we were in store for 4 rate cuts next year. Now we're looking at 2 instead. Is that how this develops?
Well, I think for now, the focus still for the Fed is going to be on data dependency. So the CPI data today will be absolutely critical in terms of and how data unfolds over the next few weeks and months in terms of where's the labor market data, because at the end of the day, that's what the Fed is going to be focused on, is where is the labor market and where is CPI. And if both are in line in terms of meeting their expectations, then we could see cuts. The key thing, though, especially in the longer term, is how fiscal policy unfolds. We've already seen the impact on the Bank of England and how the Bank of England has become more cautious because of inflationary concerns, because of an expansionary fiscal policy. That might come back into the fore, especially for the Fed, but still, it's too early to tell where fiscal policy is headed, how the tariffs unfold. So I would argue that the outlook for the Fed is a little bit more clouded than, let's say, it was maybe 2 weeks ago.
Yeah, and we're seeing that sort of reaction today in Asia. You're seeing, for instance, the 10-year yield there up around 10 basis points. But it is that watch ahead, of course, U.S. inflation, where the Fed goes. But there's also that reaction. What does it mean in that environment where we've got higher rates, a stronger dollar, a negative for Asian equities?
I think overall it's negative for emerging markets. We see the broader implications on Asian equities. We see the broader implications on the currencies and where they're headed. Unfortunately, you'll see increased volatility. A stronger dollar doesn't bode well. Even though you're seeing looser financial conditions in the U.S., it's not translating into the rest of the world because of what's happening with the dollar. So the dollar is a key headwind for a lot of Asian markets and will continue to do so. And now that could be pared back, and the dollar could lose some steam if we see a softer inflation number. But core inflation is expected to come at 3.3%. That's not something that's going to give the Fed the assurances that it's headed in the right direction. It does look like the last mile is quite sticky. So as a result, you're going to see that the equity markets, especially in Asia, are going to react negatively when the dollar still remains quite robust and the trajectory of rate cuts looks not as aggressive as it was before.
That was our Bloomberg MLive strategist, Mary Nicola, there in Singapore. And coming up, a very big interview ahead. We're going to hear exclusively from the Hong Kong Financial Secretary, Paul Chan, about how the financial hub is reviving its economy amid China's slowdown and rising geopolitical uncertainties. That's next. We're just 30 minutes into the session so far for mainland stocks, and the CSI 300 just managing to at least erase those losses, if not perhaps head into positive territory. We'll track that throughout the session. More ahead. This is Bloomberg. All right, two faces very well known to us, of course, in the tech community. You've got NVIDIA CEO Jensen Huang there speaking with the SoftBank founder Masayoshi Son this morning. SoftBank's actually holding a company event in Tokyo, and so far some of the headlines dropping from this conversation, well, NVIDIA is saying that SoftBank is building its first computer with the Blackwell AI system. This is going to be a really powerful AI supercomputer in essence here, but we know that Masayoshi Son is someone who's saying that they're ready to make a major investment in AI. We're going to leave that there. We'll turn now to what's happening here in Hong Kong this morning, because this is the 2024 APEC World Pension, Social Security and Sovereign Wealth Fund Summit underway in the city this morning. It's an annual gathering of asset owners and institutional investors. Our Chief North Asia correspondent Stephen Engel is there for us. And Steve, a very big guest with you at your side.
Yeah, that's right. We're on the beautiful rooftop of the Royal Hong Kong Yacht Club overlooking Victoria Harbour with our special guest, the Financial Secretary of Hong Kong, Paul Chan. Thanks so much for joining us. Obviously, you're the big pitch man for Hong Kong here at the APEC World Summit. Downstairs, there's a number of different sovereign wealth fund managers here. There's government officials. There are pension fund managers. What's your main pitch to Hong Kong? Obviously, Hong Kong's back, and it's a worthy investment destination, right?
Yep, and it's thriving. Yeah, it's thriving in terms of asset and wealth management, in terms of the economy. Also, we came out from pandemic last year. Economic growth last year 3.3%. This year is between close to 2.5%. Yep, within our range. Stable economy, unemployment rate is low, inflation is also very low, property market stabilizing. So we are very well geared up for growth.
What kind of specific incentives, though, are needed to attract wealth here? I know family offices have a choice to Singapore or here or elsewhere. The stock market, we all know, has not done well. The Chinese economy is slowing. There's geopolitical headwinds, which we'll talk about in greater detail later. But what specific, sweeteners do you need to offer?
Well, for family offices, at the moment, we have about 2,700. And over half of them are managing assets of over $50 million. We offer a range of tax concessions and very competitive.
Very competitive.
Very competitive.
Against whom, though? So, again, Hong Kong's gone through a tough period. And it needs to get its mojo back, is the way I've been trying to describe it. what else needs to be done to get those fund flows, seeing the risk mitigation is in place, to park their money here, not just temporarily. Money's flowing across from mainland as well. They're buying wealth management products and the like, but it needs to be guaranteed to stay here and invest long term.
Well, it would be the value proposition of Hong Kong, firstly as an international financial center, and in particular for the sector you mentioned, the thriving asset and wealth management sector, and also the government is investing into the future of Hong Kong in terms of various infrastructures, in terms of growing our innovation and technology sector. So I firmly believe Hong Kong still offers excellent value propositions for investors.
Now, Xiao Baolong, he's the director of the Hong Kong and Macau Work Office, essentially invited Hong Kong officials as well as Hong Kong business leaders to cross the border to Shenzhen within the last week or so. He says Hong Kong must beef up its traditional industries, obviously, its strength, explore new industries and models, and deeply integrate into national development. That is a broad marching order, obviously, from Beijing. What's your number one priority right now?
Well, actually, Director Hsiao pledged again the strong support from the central authorities to Hong Kong and reiterate the importance of one country, two systems, and encourage the government and the business sector to work together to grow the economy. Well, you know, GBA is one of the development Greater Bay Area is one of the opportunities. But more than that, in Hong Kong, we want to diversify our economic structures. Apart from financial services, innovation and technology is the handle. And we have chosen 4 areas: artificial intelligence and big data analytics, biotech, fintech, and new materials, new energy. So all these are thriving sectors. We need to work with the business sector to roll out facilitative government policies and even, if appropriate, to co-invest with them. We have set up an Hong Kong investment company to do that.
Your traditional strengths are in financial services, obviously, trade finance, as well as, of course, shipping and logistics. So to add onto that, IT and innovation is going to take a monumental shift, is it not? To essentially put the resources, how much resources need to be allocated towards that to make sure that innovation takes hold? Because Hong Kong's not known for its IT innovation. That went across the border to Shenzhen and Guangdong province many years ago.
That is a misconception.
Okay.
Actually, over the past few years, the government have invested over 200 billion into building the infrastructure, rolling out different incentive policies, facilitating tech companies to settle into Hong Kong. And we set up a Hong Kong IC, Hong Kong Investment Company, to co-invest with them if they like. So in the tech sector, although we start only in recent years, but we can leverage the synergistic collaboration with Shenzhen. We have the advantage of international facing. We have the advantages of having both mainland and international data, mainland and international talent, and the full range of financing available to tech companies at different stages of development.
How about diversifying your emphasis? Maybe perhaps not necessarily away from the West, but having more client base. I know there's been greater integration and dialogue. Well, the ETF exchange as well with Saudi Arabia. I saw a news headline: China will sell dollar bonds in Saudi Arabia next week. First time dollar bonds since 2021. How does Hong Kong play that role as a bridge between China's ambitions and what is happening with Saudi Arabia? Because again, we have the ETF Connect as well.
Well, to us, being an IFC, it is important for us to continue to reinforce our relationship with the US and Europe. These are key investors. But at the same time, we need to open up new capital sources and good companies to come to Hong Kong for listing. That is why we devote energies to the Middle East as well as ASEAN. So we want more capital and more good companies from that part of the world to come to Hong Kong to use our platform.
But speaking of bond issuances as well, we just saw that Hong Kong has auctioned renminbi bonds twice in the last couple of months. Is this going to be a regular occurrence, and will we see the size of these offerings grow?
Yeah, we want to position Hong Kong as the best and the largest offshore renminbi business hub. So it is in our interest to have more diversified products to offer to investors. So we encourage those renminbi bonds to be issued in Hong Kong.
How do you see as well the Connect program expanding? I think it's the 10-year anniversary. We'll be speaking to Bonnie Chen at the HKEX at the beginning part of next week. Where do you see and where are the talks in expanding that? Perhaps to, the IPO direct Connect and other vehicles?
That is bound to expand. Number one, currently it is more with the GBA, say for example, Wealth Management Connect. In terms of stock market, it is Shanghai, Shenzhen, and Hong Kong. And at the moment, this is the most trusted conduit for international investors investing into the mainland. Over 70% of this investment are looked for Hong Kong. We see tremendous opportunities in terms of diversifying the product offering, deepening the collaboration, and also lowering the threshold for more investors from the mainland to come to Hong Kong for investment.
Do you see some of these thresholds changing in the next year or so? And also, where are we on the primary connect, where you can get some big companies from overseas coming and having a secondary primary listing here?
Yeah. Well, we are working very hard on that, and there will be announcement at appropriate time. At the same time, it is important for us to be able to offer international companies to be listed here, to be included in Southbound Connect, so that they can tap both international and mainland capital. That would improve their liquidity.
What's your ambitions for commodities tradings? A lot of that has been dominated down in Singapore. There's been talk of an LME type of warehouse here as well. HKEX owns the LME, opportunity for synergy there. Where are we in those talks?
Well, in the policy address recently released by the chief executive, we are going to set up the gold trading center. This is the first step. The way we see it, this commodity center development would be interrelated to Hong Kong's position as international shipping and finance center. So in the coming years, in the coming months, we'll continue to work on that to expand the scope of that offerings, and at the same time do the proper facilitations.
You talked about shipping. I'd be remiss not to talk about the geopolitical situation around the world. Obviously, with a perceived more protectionist gentleman in the White House come January, and with pledges of tariffs on Chinese products of up to 60%. How does Hong Kong weather that particular blow? Much of your exports, the bulk of your exports, are re-exports in and out of China.
Well, there are challenges and opportunities. Yes, what you have put, but on the other hand, we have seen the business sector responding. Say, for example, redistributing their industry chain. So we position ourselves as the supply chain management center, and also providing consulting services for these companies when they want to reallocate their supply chain in the region and try to consolidate their positions and open up new markets.
How much, though, could this? You have to have contingency plans. What levers do you have to enact if he follows through on what he is going to say he's going to do? I'm talking about Donald Trump, of course. You've already said that the outlook for GDP growth, I think the previous forecast for full-year growth would be between 2.5% to 3.5%, but you're now saying at the lower end. How do you protect that lower end of the band of growth?
Well, interest rate is coming down, which is good for business, good for the asset sector. And at the same time, our efforts in attracting strategic enterprises and talents are bearing fruits. At the moment, at least 100 strategic enterprises are coming. In the next couple of years, investing over 40 billion to 50 billion Hong Kong dollar, creating 17,000 quality jobs. We have approved those talents under the various schemes, about 230,000, and about 160,000 have already arrived in Hong Kong. These are the drivers, the impetus to help us grow our economy. And these talents are in the sectors that we need. So it would be very important for us to embrace them and to work together to grow ourselves not just in the financial services sector, but also in the technology and innovation.
One of the great strengths has been the consistency of the dollar peg, obviously. Yep. There has been chatter out of Washington that perhaps the new president-elect would like to see less independence from the U.S. Fed. Is there any scenario that you would be considerably worried because of the dollar peg and essentially de facto central bank is the Fed?
Well, the pegged exchange rate system works very well for Hong Kong. We have no intention at all to change that. We have experienced different challenges over the past few years, so we have plans in hand to respond to any circumstances.
What plans are those?
I'm sorry, this has to be kept confidential.
Okay. So lowering of the Fed interest rates, obviously easing there, it might be a bit of a pause because the U.S. economy is still going great guns. How do you see that affecting, though, the property market here, which is still a bit in the doldrums?
Well, recently we observed the price being stabilizing. Volume went up. This is a good sign. Going forward, we have been very careful in terms of land supply and monitoring very closely in terms of the incoming productions, the compete effects.
What needs to be done, though, to help stimulate the property market? I mean, a lot of these towers over here in Central Business District, a lot of new buildings coming online, including the Henderson, a lot of vacancies, retail space. The landlords are not bringing down their rents, and a lot of shops have been closing up. Residential property is suffering as well. What specifically can you do and say to them right now that this can be resolved? Do you need to tax landlords, retail landlords, for example, of keeping shops unoccupied?
Well, in terms of residential property market, it has been stabilizing. We don't think we need to do anything except closely monitoring the market to make sure there is no malfunctioning. In terms of office, in terms of retail, it is basically a market force. So it may take time for the landlords to respond to market changes, but I believe they would be realistic.
Paul Chan, 15 minutes went by quickly. Will you come back and talk to Bloomberg Television?
Yeah, anytime, Stephen. Thank you for the opportunity.
A very optimistic tone from the Financial Secretary, Paul Chan, here on the rooftop of the Royal Hong Kong Yacht Club. And we avoided the rain. Taraji kept at bay this tropical storm churning off the coast of Hong Kong. Back to you guys.
Yeah, Steve, that's right. Wind alert coming through this afternoon, but I'm so pleased that Paul Chan has just committed to interviews anytime with Bloomberg News. That's really great for us. And as we're just hearing there, the Finance Secretary, Paul Chan, saying that the city's economy is thriving and in a stable position as well. But if you've missed out on that and you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and our guests during our live programming. So check it out at TV Go. This is Bloomberg. We're taking you to what's been really the top red story this morning, and that is Elon Musk being appointed alongside Vivek Ramaswamy to lead a new government agency under the Trump administration to focus on cost-cutting and efficiency. So it's going to be called the Department of Government Efficiency. I mean, the links to Doge, and we're seeing that Dogecoin rise in tandem this morning. But going to be getting more details on this. And Elon Musk actually has just given an update through the X platform, saying that all of the actions of this newly created department are going to be posted online for maximum transparency. And this point I really like as well. He's actually asking for any sort of public feedback, because if anyone thinks that they're cutting something important or not cutting something that's wasteful, he's urging them to get in touch. They're also saying they're going to have a leaderboard for spending that he thinks is not being put into wise places, to put it nicely, but don't really know how that leaderboard essentially is going to be functioning. Still, though, that is the most read story this morning. Let's also take a look at what's happening in Japanese equities, because we've just had them going into their lunch break this morning. Lots of different movers here across the landscape, given we've got earnings that are in full force. SoftBank as well, we're seeing that stock a little bit under pressure so far this morning. We actually did see their shares moving higher after they reported better than expected quarterly net income and a return to profit at the Vision Fund. We are, of course, as well, getting some headlines that are just crossing the terminal this morning. This relates to the Seven & I buyout, and they're actually saying now, Seven & I, that they will consider a $58 billion management buyout. They will consider that MBO if Couche-Tard, of course, we've seen that takeover or buyout effort from Couche-Tard, the Canadian company, for several months now, but they will consider if it becomes aggressive. They're also saying that a buyout would involve the Ito family, Itochu, and Japan mega banks as well. So that's a stock we're going to be watching very closely here. That news, though, has come as Seven & I has gone into the lunch break, so no trading reaction on it just yet. Still, though, something to be tracking very closely. Of course, that management buyout has been closely tracked. That is actually coming through a Bloomberg exclusive this morning, so we'll see if we can get more details on that. Let's also take a look at broader markets this morning. Asian equities really reacting to two twin forces. We saw a stronger dollar, unchanged right now, the gauge, but we have seen it trading around its highest level this year. We also saw treasury yields rising, really traders rethinking their expectations around how many Fed cuts we're going to be seeing next year. We've heard from a slew of Fed officials saying that they are prepared for any sort of economic eventuality, but it is that question really over what President Trump's administration means in terms of tariffs, also corporate tax cuts, this focus on deregulation. Does that restoke inflation? We will get the inflation reading as well out in the US later today. We're going to head back now to the APIC conference, though. We're also going to be hearing from the Apollo Global Management co-president, Scott Kleinman, who says he's not convinced that the Fed has won the battle against inflation. He told us exclusively that price pressures already persist ahead of any potential impact from Donald Trump's policies.
I think rates are going to be higher for longer because inflation is not tamed. The Fed can say what it wants. You just have to open your eyes and look around. Think about the last flight you were on and how crowded it was, or the fact that you're paying $85 for a steak and next week it'll probably be $90. Or housing prices, right? Everywhere people want to live, right, there's not enough homes. Housing prices are going up, notwithstanding, the backdrop of the rate environment. And so we see inflation not as beaten, but as suppressed. And the more the Fed cuts, the more you're lifting your hand off that lever to hold inflation down. And look, nobody's got a crystal ball, but we live in a world that is the mega trends that are driving the world today are pretty inflationary. You have things like the build out of the digital infrastructure. So between chip fabs and data centers and the power that's needed, that's $100 trillion we have to spend over the next decade. The decarbonization, the deglobalization of the economy, all of these things are inherently very inflationary. Then layer on top of that what might be, some of the new administration's policies that are, that sound inflationary, deficit spending, so some of these other programs that are going to add to inflation. It's very hard to say that inflation is beaten or inflation is over. That doesn't mean inflation is going to run away. It just means we're going to have to live with a higher rate environment for a lot longer.
And you've been really good and really right on this idea that we're going to have a higher rate environment. And one of the things you said at a conference in Berlin this year, in what feels like a lifetime ago in June, is that not everything is going to be okay, that we're going to have some refinancing coming into the market, and it's going to be a problem for a lot of private capital. Again, that was in June. Is the moment of reckoning nigh now?
For sure. We're getting closer and closer to this. As I alluded to back then, invested in a lot of companies, over the 5 years leading up to 2022 before the rate change happened. Good companies, but at very full prices. So sitting here today, when private equity companies firms would be normally selling their portfolios, they're stuck. They're holding on to big portfolios of good companies, right? I'll posit that most of these investments are good investments. They just paid too much for them given the current rate environment. And so they are saleable, but maybe not at prices that these private equity firms would be happy with. And so they're going to hold on to them. And by holding on to them, you have grumpy LPs who aren't getting their cash back at the rate they thought. And then you also have refinancing issues, right? Okay, well, now if I'm holding this longer, I have to refinance it. And so how do I do that? Some companies will have no problem. Others will have to start being a little more creative. And we're absolutely seeing that. Part of our business model is to help those companies, those other sponsors that might need capital somewhere in their capital structure to help get through this next hump. Because again, most of these companies are actually good companies. The sponsor just paid the wrong price for it.
Is the matter made even worse at this moment, though, than it looked in June, considering we might have more inflationary policies coming in 2025?
I think it only lends credence to my theory. We'll put it that way.
That was the Apollo Global Management co-president Scott Kleinman speaking exclusively with Bloomberg's Danny Berger. And we can return now to our coverage of the annual APIC World Fund Summit in Hong Kong. Our Chief North Asia correspondent Stephen Engel standing by with our next guest, Steve.
Yeah, the dialogues down below us are covering a lot of the different funds that Hong Kong obviously is seeking to attract, whether it's pension funds, social security funds, and also sovereign wealth funds. And we have a member of the New Zealand Super Fund with us. He is Doug Bell. He's a Director, Investment Strategy at the Sovereign Wealth Fund in New Zealand. Thanks so much for joining us. So what is your message downstairs, and what are you also trying to glean from the story that Hong Kong Financial Secretary Paul Chan and others is pitching to funds like yours?
That's right. So, the key message really is it's a wonderful gathering here today of lots of pension funds, sovereign wealth funds from around the world. One of the messages will be just to sort of share the story of NZ Super, about our history, how we approach investing. We run what's called a total portfolio approach to invest in, which is, it's somewhat unusual within markets, although it's getting growing adoption. And just a bit of the story around how we've adapted our strategies through time as market conditions have changed. It's important to emphasise, and I certainly will be emphasising this, that we are a very long-term investor. Yeah. We've been established now we've invested for 21 years. We've got a very long investment horizon. We're not expecting, as a sovereign wealth fund, we're not expecting to make distributions for a number of years from now, until the mid-2030s, in fact, before the first distribution. So our strategies evolve slowly through time, and we very much the mantra internally is sort of evolution, not revolution. That's the sort of key messages will just be sharing some of the stories around what we've been doing.
You are one of the better performing in the last fiscal year sovereign wealth funds, up about 14.9% on year. About 44% of the portfolio is in global equities. The global equities out of the United States have done really well. How are you looking at and recommending the strategies as we head into a lot of uncertainty going forward as the Fed starts reducing rates, a new man in the White House, a lot of uncertainty?
There's always uncertainty. Yep. There's always uncertainty. I think I would go back to the point I made just now is that we're a very long-term investor. So things like our starting point is an 80% global equity, 20% global bond portfolio. That's what we call our reference portfolio, which is a reasonably, compared to many of our peers, is a reasonably sort of aggressive expression in terms of the risk appetite that we're willing to take, but it's really a reflection of our long investment horizon. So we don't make drastic changes around that. That's something that's reviewed periodically, and it's a reflection of our change in risk appetite through time and so forth. But those things don't change too dramatically.
What do you see in Hong Kong and the opportunity there? The Hong Kong Stock Exchange or the stock market has been depressed. China is slowing a little bit, and you've been exposed, as I said, in your portfolio, about 44% to global equities. Does Hong Kong have a bigger role to maybe up that if you're seeing a bottom?
I think we don't generally make sort of specific country allocations in that way. But I think one of the reasons I've been here is just sort of reconnect with peers, asset managers, and so forth. And I've been periodically coming back over the last couple of years to Hong Kong since the restrictions have been lifted. And every time I come back, there's more peers here. There are more, there's certainly more international flow coming through Hong Kong, which is great to see. And it's also a great opportunity just to reconnect with people and see what's going on.
Yeah.
We see this more as a sort of external relationships and maintaining, building relationships around the world.
Are there areas that you're exploring as well? I know you talked about that ratio. Global equities right now 44, bonds 21, New Zealand stock market as well 4%. But you said as well that you take on a little bit more risk and that you've seen the reward there. Are you looking at other types of investments like private equity? There are tons of pools of private equity here in Hong Kong, and looking at various opportunities.
We invest across the full range of alternative asset classes. And we've had sort of a number of, we've got in excess of 20 plus active strategies that we run. Many of those are alternatives, which includes venture, private equity, growth equity, buyout, and so forth. A whole range of hedge fund strategies in there, equity factors, all sorts of things that we invest into. And we look at that on a global basis. So we do assess, in the private equity space, we look at that globally. We look at opportunities globally.
How high is ESG as well?
Yeah, it's a really important point. ESG, sustainability for NZ Super is extremely important. It's something that's been evolving. I mean, we've been sort of, very focused on that for many, many years now. We really upped the ante a few years ago where we sort of introduced the Paris-aligned benchmark into our sort of reference portfolio. It's also a sort of increasing ambition around sustainability and the integration of that within everything that we do.
The last question I have for you, though, is with that 44% allocation in global stocks, do you see reducing that potentially as the risks mount up right now? And the stocks are pretty frothy in the U.S.
So there's the 44% allocation, we have a reference portfolio which is very stable through time, and that's the 80% allocation. We make then take active positions off the back of that, which is funded through the reference portfolio into lots of alternative strategies. Again, that evolves slowly through time as we see active strategies evolve. We do run a strategic tilt-in program within the fund, which is essentially a systematic type of program, which does move a lot more dynamically based on valuations in markets and so forth. But that's very systematic.
Doug Bell, NZ Super, thanks so much for joining us on the rooftop here at the Royal Hong Kong Yacht Club. I could get used to doing reports from here. Back to you, Annabelle.
Well, actually, Steve, I've even had some viewer feedback this morning saying what a great backdrop behind you. So that was our Chief North Asia correspondent, Stephen Engel, there speaking with Doug Bell, Investment Strategy Director at the New Zealand Super Fund. And we'll have more ahead. This is Bloomberg. Bloomberg's learned that 7&I is considering a management buyout to take itself private with funding from banks, trading house Itochu and its founding Ito family. Let's get more on this scoop from Bloomberg's Reed Stevenson in Tokyo. And Reed, this is certainly a very interesting development in what has been quite an aggressive approach from Couche-Tard.
Indeed. This is probably, if consummated, it would be the biggest ever management buyout in Japan. 9 trillion yen, $58 billion. It would involve a variety of entities, the founding Ito family of 7&I, as well as Itochu, which actually runs a competitor to 7-Eleven, the Family Mart network of convenience stores, as well as some existing equity investors, and 6 trillion yen in financing by Japan's top 3 mega banks. And so this is quite a complicated deal. We just reported this minutes earlier. And essentially what's happening here is that 7&I is sort of preparing for a scenario of sort of a hostile situation with Couche-Tard, which of course has made its own bid or potential offer for 7&I of around 7 trillion yen. And so how this plays out is going to be extremely interesting to see. But I mean, 7&I is definitely in play here.
Do you think that this is going to win over investors, this possible buyout?
Essentially, I think it's a little speculative here, but it's sort of a scenario where investors, shareholders would be presented with a choice. Effectively, even if 7&I enters into negotiations with Couche-Tard, Will they choose to be bought out by a foreign entity, the operator of Circle K stores from Canada, or will they choose management buyout, which at the moment is actually the higher price? So that's really a lot of speculative sort of scenarios that will play out probably in the coming weeks and months. At the moment, all we know now is that there's been this very, very dramatic development in the 7 & I story, and really quite an interesting situation for corporate takeovers in Japan.
That was Bloomberg's Reed Stevenson there in Tokyo, and really great reporting. That is an M&A exclusive from Bloomberg this morning. As we said, this could be the largest ever management buyout in Japan if it does go ahead. So 7 & I said to be considering a $58 billion management buyout. Let's shift now, because the focus as well this week, at least in China, is very much on the tech space and earnings that are coming through. Tencent is going to be one of those up later today, and we're joined now by Bloomberg Intelligence senior analyst Robert Lee. So Robert, we've seen those sort of long-standing efforts really at Tencent to try and cut costs, streamline the business. We've seen that sort of renaissance in the gaming space as well. So does that bode well for the numbers later?
It does, but I think that is well understood and anticipated by the market. So it's really the gaming business which has been driving the story through this year. But there is a degree of seasonality within games, and whilst the numbers themselves, I'm not worried. In terms of the reported numbers, we could probably see another margin beat from them. But the big question for me, and I think for the market as a whole, is, what about the outlook through the rest of the year and more importantly into next year? I think we're likely to see signs of incremental weakness coming through, particularly on their core fintech business and ads as well, which are more economically sensitive. So I think the scope for a bit of a change in the narrative. It's been an absolutely stellar, blowout year for them. But again, that's known. What about next year? Based on our numbers, and I think consensus as a whole, EPS growth for the company's going to reduce way down and normalise to 10 to 12% next year versus close to 40% this year. So, yeah, I think there's a scope for a shift in narrative on them.
Yeah, exactly. Because, as you said, really, we've sort of talked about cyclicality within the gaming business, and maybe that story and that improvement for the bottom line could sort of start to peter out, if not in the fourth quarter, but by the first quarter of next year. So what's sort of the landscape then? You mentioned sort of the weakness in fintech and advertising. Does that become a bigger problem for the company? Is there something else they can do, for instance, around AI?
Yeah, I think, on a relative basis, Tencent is less exposed to the macro headwinds compared to some of their e-commerce peers, but it's not immune because it's a ubiquitous part of life in China. So, again, I think we'll probably see management taking a slightly more cautious tone on that front. But fintech and ads are, major, they're major businesses that underpin the earnings outlook. And as they say in games, you're only as good as your next big hit. So DNF Mobile has been a fantastic, strong hit for them this year. But again, that has largely played out now, and it's well known and anticipated. As for AI, I think the best way that they can capitalise on that is to realise cost and efficiency savings in their business. But given the price war in that sector at the moment, they're unlikely to, or they're going to continue to struggle to monetize it.
Right, that was our Bloomberg Intelligence senior analyst there, Robert Lee, talking about Tencent earnings due out later today, but also some more breaking news crossing the terminal just in the last couple of minutes. Korea Zinc has proceeded to withdraw its plan to raise $1.8 billion in new shares. You're seeing a positive investor reaction off the back of that, but essentially we knew that the board was meeting on Wednesday to decide whether or not to proceed with this plan. It had prompted a sell-off in the stock before that, and it had also triggered an investigation by the country's financial watchdog. This is the world's largest zinc smelter, and they have been caught up for months, really, in a fight between the largest shareholders over the strategy and direction. But they've withdrawn that plan to raise $1.8 billion in new shares. More ahead. This is Bloomberg. All right, we're going to be watching shares of food delivery platform Swiggy making their trading debut in Mumbai today. That's after a $1.3 billion IPO. Bloomberg Intelligence tech analyst Nathan Naidu is joining us now. And this is, or Zomato rather, is the biggest food delivery app in India. But how does Swiggy's valuation stand up? And as you were just saying, this is the second biggest listing we're seeing in India for 2024.
Well, in one word, it's expensive. You know, even if it is at a 40% discount based on forward EV to sales to Zomato, it is at 80% premium to global peers. And Swiggy is investing heavily from its IPO proceeds into quick commerce. A space that's getting a lot of competition from the likes of Flipkart, India's biggest e-commerce company, as well as Zomato, which is already profitable. For the record, Swiggy is still loss-making. So we are seeing that it might not break even until 2027. And that's the reason we believe that the valuation is lofty.
A lofty valuation doesn't really bode well for the start of trading. And some people sort of talk about an India IPO curse where we don't see such a great reaction in the first few days. So what's sort of the outlook then, do you think?
I think, there's an India premium going on, but, we are seeing signs that the tailwind might not help Swiggy sustain its lofty valuation rather. If we look at all the past 18 mega IPOs in India in the past 20 years, 11 of those had a weak debut, including what you just mentioned, Hyundai Motor India, which is still about 6-7% below its initial IPO price. So we're seeing that, investors might be waking up to the lofty valuation in India, and Swiggy IPO is not immune to that.
All right, that was our Bloomberg Intelligence equity research analyst for technology, Nathan Naidu there. And a quick check on how markets are faring here this morning. Watching the Hang Seng in particular, because we are close to erasing all of the gains now since September of this year. So really the moment at which we saw that major amount of stimulus being unleashed into the market. So the HSI, of course, really bearing the brunt of that. The CSI 300 perhaps doing a little bit better, but still something we're tracking very closely. Very heavy day of news headlines as well to note. Just recapping some of the ones that have really been amongst the most read. One of the ones in the last few minutes is Korea Zinc, and we've seen the company, for instance, rather not for instance, but the company deciding on their share sale amid rising pressure here from shareholders. But essentially, they've decided not to proceed with a $1.8 billion share sale plan. Other things that we've been tracking as well throughout the course of the day, Donald Trump tapping a number of different people to join his administration. Some of the ones that are most notable, we saw Elon Musk, Ramaswamy joining a government efficiency effort. We've also seen a new defense secretary coming through as well. That's it. This is Bloomberg.